Let's talk more about Wells Fargo now. In today's conference call, executives at the bank painted an improving credit picture even as revenue continued to decline. Joining us now is Howard Atkins. He's the CFO of Wells Fargo, and he is joining us from out in San Francisco. Howard, thank you so much for joining us. I want to get to the credit quality issue first of all, because you said in the statement that credit quality turned a corner. What would you say is contributing the most to that? Is it loan modifications? Is it that you're basically getting more back on some of the loans that had been bad? Is it that you've tightened credit standards to the point where credit quality is getting better? What's contributing the most here?
It's really a combination of all. We had a 16% decline in charge-offs in the quarter, which is one of the reasons we made the statement about credit quality turning. We've been at work in reducing risk in our loan portfolios for over 2 years now. And we naturally get to a point where, losses in the portfolio are diminishing. And it's a combination of loan modifications, which we've been very successful at, exiting certain businesses, which we did 2 years ago, well before the pack. And again, as a result, we're seeing significantly lower losses in our loan portfolio right now.
As I'm sure you're very aware, there's a lot of concern now about a double-dip recession in the economy, or at the very least, things continuing to be very slow for quite some time. What effect is that going to have on the continuing loan losses at Wells Fargo?
Well, we see the economic recovery as being uneven. We don't think there'll be a double dip, but admittedly, the recovery seems to be a bit uneven. There are signs of strength in the economy. There are signs of perhaps some slowing down. But again, the improvement in credit quality that we're seeing is really what we've done on our own to improve credit quality through modifications and other factors that I mentioned, and not so much a function of the economy. Now, clearly, if the economy were to take a very significant dive down, then that might cause some problems down the road. But from what we're seeing in our numbers, our early indicators of credit quality are all looking very good right now.
Howard, I'm curious if the bank is under political pressure at all to loosen credit standards somewhat. I mean, obviously, the administration would like to see money flowing into the economy, small businesses in particular getting loans. Is that something you're hearing directly from them?
Well, we've been at work, for 2 years now, trying to supply credit to the economy. Our doors have been open for a long time, and in fact, we have supplied very significant amounts of credit to the economy, principally in mortgages. And in fact, in the second quarter of this year, we actually began to see some increases in actual loans outstanding in commercial, autos, and a few other loan products. I think the issue that we've seen while we've been supplying credit to the economy for 2 years now, loan demand has been relatively soft as consumers have pared back their spending and their borrowing. And as many commercial customers remain very liquid, they're not borrowing from the banks. So commitments are going up. Loan outstandings are not necessarily following, but we saw some signs of demand in the second quarter.
Howard, I want to talk about mortgage servicing and the hedges against the mortgage servicing business. One analyst in particular is concerned that because you all have done well with these hedges, that you've gotten a good amount of profit from it, that hides some weakness in the underlying business. How would you respond to that?
Well, I think just the opposite is the case. Our mortgage hedging results actually were down from a year ago, which means that the sales part of our organization, the part of the revenue that's being driven by sales has gone up. So we're seeing improved sales growth in deposits, in loans, in mortgage applications. Mortgage applications were up about almost 20% in the second quarter. We're seeing growth in asset-based lending in commercial businesses. So the things that are really driven by our sales machine, which we always excelled at, and perhaps we're gaining market share, have been growing. And what declined this past year actually was the mortgage hedging result.
So what do you do going forward, though, to boost the revenue further? Because if you're looking at year over year, revenue actually fell by about 6%. If you're looking quarter over quarter, it was little change. So how do you get that sales machine, so to speak, to actually turn the revenue picture around and see some growth?
Well, as I say, those numbers you just quoted are sort of mortgage hedging down and sales up. And that's really the hallmark of our organization. Our business model is focused on cross-selling the 80 different businesses we have at Wells Fargo to our consumer and commercial customers. And we continue to get record cross-sell numbers every quarter. And now with Wachovia being part of the Wells Fargo organization, Wachovia's cross-sell numbers are going up. We had a 7% growth in Wachovia's cross-sell just in the last year under Wells Fargo's direction. So that's another source of revenue growth.
So just to clarify a little bit here, I'm talking overall revenue here down 6%. Are you saying that a lot of that is attributed to that the hedging revenue was down year over year?
All of that is the mortgage hedging results, which were particularly strong last year and have now normalized this year. So if you look below that one particular item, we've gotten a very strong revenue growth from our sales machine, if you will.
Howard, unfortunately, we're out of time, but thank you so much for the time that you did give us today. Howard Atkins is the Chief Financial Officer of Wells Fargo.